Well, good morning, everyone, and welcome to the May version of the Ag Economic Dialogues. I'd like to thank everyone for attending today. Hopefully you can hear everything that's coming through your system at this time. If you do have questions throughout the day, we'd encourage you to either type them into the chat box down there at the bottom of your screen, or please feel free to unmute your microphones and interact and ask your questions directly to our presenters. We're very happy today to have Drs. Santos and Wang join us for the presentation. And to kind of keep us on track and make sure they get their full allotted time, I'm going to turn it right over to Dr. Santos and have him take it away from there. So welcome today, and Dr. Santos, it's your show.
Oh, thank you, Heather. May I share my screen?
Please do.
All right.
Do you have,
Let's see.
there you go.
How's that?
Looks great.
Looks great. Okay. Let me just queue up. Okay, good. All right. So good morning, everyone. Thanks for this opportunity. I want to echo Heather's encouragement to interject at any moment, ask questions, raise hands, do whatever you wish, but I encourage you to just go ahead, and I know it's going to feel like you're interrupting, but that's the world we live in right now with Zoom. Just start talking and I'll stop talking and listening, start listening. So with that, I'm going to go forward. When Heather asked me to join the group today, she mentioned that there might be some interest in some of the macroeconomic issues surrounding COVID and the post-COVID world. So I thought it might be interesting to take a look in particular at the inflation situation in the US economy right now. And this is quite timely, as we all know. This was from the Wall Street Journal. I'm sure many of you are familiar with this headline by now, that the inflation data was released by the Bureau of Labor Statistics a Wednesday ago. And what made all the news was this 4.2%. This was a year-over-year measure of a change in the consumer price index. And the interpretation by most was that this was higher than expected and that this might encourage central banks to tighten in ways that we might not have otherwise anticipated, and so on. So I want to pick up on this issue of inflation now as we go forward. Take a look at what the Bureau of Labor Statistics actually reported. Take a look at how they report it, what they actually calculate when they mean year over year, and what this might mean going forward. So again, please interject if you have any questions. Otherwise, I'm going to go right to the data. So the first thing I want to show you is the consumer price index. This is what we think of as an average price level. It's a very abstract notion, but imagine going into a supermarket with a grocery list and taking that same list month after month after month and buying everything that's on the list. So the list doesn't change, but the total expenditure could if prices change. And so that's what you've got here, is a general tendency for the price level, the average price of goods and services, to increase over time. And what the Bureau of Labor Statistics reported was a number that got almost no press, which was the average price level as of April 2021. Now, what we do with those data is we don't actually report so much the price index, but we report the inflation rate based on this price index. So we do what we call a year-over-year calculation. It's not the only way to do this, but this is what that 4.2% was all about. And essentially, you can imagine taking, I don't know, let's say that's in April, and you look at the prior April, and maybe that's in May, and you look at the prior May, and so on. And you do this year-over-year calculation to come up with an inflation rate, and that's what everybody was talking about. When you do that to the consumer price index, you get, for the last month, this 4.2%. And as you just take a look at that picture there, you can see that 4.2% isn't the largest that change in the CPI has ever been, but nevertheless, it is quite large. And certainly, if we look at just the years surrounding that, or to the left of that, as a practical matter, we notice that it was not that high for quite some time. So this received a lot of press, understandably. So what I want to do now is just think about what this is going to look like arithmetically because of the year-over-year calculation that we perform every month going forward. So what I mean by this, oh, one more thing before I do that. Let me just show you where these changes were. So it looks very COVID when you look at this list. The 4.2% that everyone was talking about, I broke down into just its primary drivers, if you will. So the way to think about this is, as I like to tell my students, how do you use that number in a sentence? Well, of the 4.2% inflation that was reported year over year, 1.2 percentage points of that 4.2 came from gasoline prices, which rose roughly 50% year over year. And then you can do the same thing all the way down the line. So used cars and trucks, for example, of the 4.2 percentage points, 1/2 of a percentage point came from the 21% increase in used cars and trucks prices and so forth. So that's just a rough breakdown. This isn't an exhaustive list, of course, but it got me down to 3.5%, and I thought that was long enough. So this list of select items contributed in the aggregate 3.5 percentage points to the 4.2%. So again, if you take a look at the list, I don't know, to my eyes, it's very COVID, right? Gasoline, rent, used cars and trucks, food away from home, medical services, communication services like Zoom, and all the rest, right? So that's important because the takeaway here is that, if you imagine the economy opening up now and supply chains sort of going back to their normal level of performance, you can imagine that much of these changes are, to use the Fed's favorite term these days, transitory. They're, if you will, blips that presumably will work themselves out over time. Okay, so now back to that issue of over time. So this is the CPI again. It's just a little bit of a shorter time series. It's the very first picture I showed you where I circled that last number like that and so on. It's just a shorter segment of time. And the reason I did this is I want to just demonstrate that prior to the pandemic, the time path of this CPI, and again, its slope is inflation. So the time path of this CPI was pretty stable, a lot more stable than my little red line just made it appear to be. And so what I did was I thought, well, what if immediately after the Bureau of Labor Statistics announced its 4.2% inflation for that month, year over year, what if the economy immediately went back to its average path? And so just a simple little linear forecast. What if that's what the future looks like, the near future looks like in this CPI? I thought it'd be a neat little exercise now to go and do that year over year calculation for the blue, which actually happened, and then just go right into the red, which of course hasn't happened. And just do that May compared to May, and April compared to April, and June compared to June, and so on. Do the year over year if the economy now, starting on May 1st, let's say, went right back to a very low and stable, roughly 2% is the slope there of the red line, 2% inflation rate year over year. What would the inflation rate look like going forward in the near term, just because of arithmetic? And so there's the blue. So again, if you take the year over year of the blue here, you get the blue. And then if you take the year over year of the red, you get the red. And what's interesting about this is you notice that it's going to take some time for the year over year inflation rate to, if you will, settle back to 2%, simply because of the arithmetic of year over year calculations. And this is assuming that everything goes back to normal immediately, which it probably won't. So another way to think about this is in the form of a bar chart, and just to say, okay, the 4.2% that the Wall Street Journal reported for April, now what if the economy goes right back to 2% inflation quarter to quarter to quarter, but we're still doing year over year calculations where we incorporate that very low base in the CPI during the height of lockdown and the pandemic. Here's a fairly conservative path for inflation for the next several months. So we're going to likely see higher year over year inflation rates, higher than numbers like 2 and 2.5 for quite some time. And I guess my takeaway message here is some of it is simply arithmetic, and we need to be aware of that because of the nature of the year over year calculation. Likewise, though, some of it is going to be supply chain jams and so on that are likely going to persist. And so my guess is the bars aren't going to look like this. they're going to look something like that. They're going to be a little bit higher for longer. And in fact, that's what the Federal Reserve has tried to prepare us for. But again, and I don't think maybe some folks are recognizing is simple arithmetic is going to mean that unless you had a sudden deflation, you're not going to see low inflation rates on the order of 2% for some time to come, as this works itself out, as it were. Okay, so that's the inflation data. That's called into question, of course, where this inflation, though, has come from. The blue bar is high. That's a 4.2 inflation rate, and that's not just arithmetic. That's a new high number. And so the question is, where did the high blue bar come from? And here I think a lot of folks are thinking of Friedman, right? Inflation is always and everywhere a monetary phenomenon. And the reason they're thinking of Friedman, they can be forgiven for thinking of Friedman, is because it turns out that not only do we see a 4.2% inflation rate, the blue bar, which is quite high, but we also, if we go to the monetary data, we see this. And this is the M2 money stock. As I like to tell my students, M2 is currency, think cash and coin, and then checking account deposits and savings account deposits and other near monies, the sorts of things you could walk into Jimmy John's with and buy lunch, right? So this is what economists think of as the money supply, broadly speaking. And what's interesting about this, these are growth rates. And you'll notice, days in the life of the economy normally look like that. And then that happened, right? So we see this enormous growth in the money stock during the pandemic because of Federal Reserve stimulus and so on. It's all of the, the usual cast of characters here. But what's interesting is at the end of the day, what we see is a rather large increase in the money supply. And so, as I say, people can be forgiven for connecting these dots, right? That we have this large increase in the supply of money, and then we just had that large increase in the inflation reading. And could the two be connected? And they can. Let me explain a little bit why folks, I think, turn to the money data. And here we just want to get a little analytical, but I find that this stuff makes a lot more sense if you've got a little more firepower to interpret it with. And so here's my firepower. It's something we call a quantity equation, and it's a very straightforward idea. And it's basically that money flows through the economy, and I'll define these terms a bit in a moment, but think like for the US economy, $20 trillion in a year flows through the economy. And it flows through the economy to create nominal GDP or income. So over any interval of time, this has to be true, that the amount of money that's flowing through the economy is flowing through the economy precisely, if you will, to buy GDP, which is price times stuff, as I like to say, right? So the way to think about this in a real straightforward way is, let's say the economy produces 8 things. I don't know what those things are, but there are 8 of them. And each of them sell for $1. So you've got $8 of stuff produced, purchased, valued, $8. And let's just say the economy happens to have, think paper money here, make it real concrete, $4. So how are you going to pull this off? How are you going to buy $8 worth of stuff with $4? And of course, the way you're going to do it is we're going to have money change hands over and over and over again, which incidentally is why using currency during a pandemic is such a health hazard. But money changes hands, quite literally, if we're talking about Federal Reserve notes. And so in this simple little example, this idea of velocity, which seems like a really abstract term, but maybe hopefully not so much now, is 2. That is $4 changed hands on average 2 times in order to buy $8 of GDP, right? So money is linked to both the price level, the dollar in my story. It's also linked to GDP, the 8 in my story. So if you use this as a launch point, you can think about how, what if I changed $4 to $6 or $7 or $8 or $10 or $50? What would happen? And over long periods of time, we actually can tease out some general features of what would happen. Some of these variables would move and others tend not to move. And so we actually can determine how introducing more money into the economy might affect these other variables. So let me walk us through a little bit of this. how money flow and income flow relate to one another. And I'll use the US economy and I'll use the last 50, 60 years, right? So what I'm going to do is I'm going to move M around because we just saw the Fed has essentially engineered a 25% increase in M, and ask the question, what is this likely to do to the other variables, right? Well, what is it likely to do to P or to Y or whatever, or what has it done, say, over the last 60 years, right? What could we take from history to get a sense of what all this money increase is going to do going forward? And just a little technical pit stop, if I may. What I'm going to be talking about here are long run trends in these variables. So over 50 and 60 years. So as a technical matter, I'm not actually going to be using the quarter to quarter money supply. That would be, say, that horrible looking thing. Rather, I'm going to be looking at the trend in the money supply, the smooth behavior in the money supply. And the same thing goes for the other variables. So again, just a little technical pit stop. When I say I'm going to increase M, I'm talking about the trend in M, the long run behavior in M, getting rid of all that noise quarter to quarter. Same thing for price, same thing for output, and so on. Okay, so long run trends in the behavior. So here it goes. We're going to move M, and then we're going to look at what happens to nominal GDP, P times Y, for the US economy over several decades. And so you get this really cool sort of serpentine picture. But what it's indicating, these are all quarters in the life of the US economy. I don't know which quarter that is, but that's a quarter where that was the growth in the money supply, and that was the growth in nominal GDP, and so on. And what you notice is over long periods of time, there's a very noticeable positive relationship between these variables. Increasing the money supply seems to have a positive, almost one-to-one. I mean, take a look at this for a moment. It's really quite astounding. That red line, that one that I add for just a visual aid, is really saying that if you have, an 8% increase in the money supply, you tend to have about an 8% increase on average in nominal GDP as well. So money tends to have that stimulative effect on nominal GDP. Now, as some of you are probably carefully listening and thinking, okay, but nominal GDP is P and Y. What about just P? And it turns out that actually most of the reason why M has an effect on nominal GDP is because it has an effect on the price level. And so again, I'm going to do the same thing, look at the long run trend, but this time it's going to be an M and just P, not M and nominal GDP. And again, you notice a positive trend over time. Again, how to read this? Well, if the money supply grows at 8%, go up, turn left, you've got roughly, a 5% increase in the price level over a long period of time. So money is contributing to an increase in the price level in a pretty reliable way. So when folks see the inflation data in April 2021, and then they see the money supply data in April 2021 and in the months prior to that throughout the pandemic, again, they'd be forgiven for thinking, well, the growth in the inflation or the inflation itself must be an artifact, a consequence of growth in the money supply, because the two are related over long periods of time, right? Okay. But of course, what I haven't talked about is V. And V, remember, is the average number of times money changes hands in order to purchase GDP. So I've shown you how increases in M can motivate increases in P. Money causes inflation, all else equal. But sometimes all else isn't equal. And during this pandemic, and even really during the period since the financial crisis, we've been living in a bit of a bizarre world when it comes to monetary theory and practice. And so V has actually had sort of a life of its own during this period. And that has essentially worked against the pressures on inflation. So let me show you what I mean. Remember, again, V is just nominal GDP divided by M. So in my goofy little example before, if you have $8 worth of stuff that we produced, purchased, and valued, and there was $4 worth of currency, well, it must have changed hands twice, right? So velocity really captures our willingness to hold money. If velocity is very low, we have what we call a high demand for money. We're willing to hold on to large money balances. And when velocity is very high, a very little amount of money is facilitating GDP. We're not holding a lot of it, right? So what's velocity done over this period? Well, here I'm going to go from Friedman to Keynes. Keynes was fond of saying, in the long run, we're all dead. The point is, right now, we can't so much focus on the long run behavior of velocity, which is fairly stable and explains why M tends to translate into P, money, into inflation. But I think we need to look at the short run behavior of velocity, because in the last few years, it's done something very differently from what it's done before. So let me show you that. And of course, what you're noticing, I think, is that, right? So we've had a fairly stable velocity. Notice this is a pretty tight band here. So velocity has been fairly stable, roughly around 2, like my goofy little example. And suddenly, though, recently, it is largely collapsed. Now, again, how do you use the collapse in a sentence? It means that we're all collectively, maybe not to a person, but collectively, cash is king. And so we are happy to hold on to large sums of money, which means it doesn't turn over as often as it might otherwise. And as a result of that, all that money that's in the economy is not necessarily translating into more inflation. So this idea that the increase in the money supply that's been engineered by the Federal Reserve to stimulate the economy is now sort of coming home to roost in the form of high inflation, it's a bit simplistic. Because while the Fed has been doing all of this, and there's no denying the Wall Street Journal announced a high inflation number, I know, but throughout this time, something else has been happening as well. And that is velocity has fallen dramatically. Now, the reason velocity has fallen dramatically, again, we can go to Keynes. Keynes sort of saw this coming in about the 1930s and said, you know, there are situations where in very low interest rate environments in particular, you do get this tendency for individuals to hold on to cash. There isn't much else to do with it, risk adjusted, speaking in terms of risk adjusted terms. And so at these very low interest rates, velocity does tend to tank in this way, or it could. And I'll show you this. This is a really interesting scatter plot. This is just looking from 1995 to 2021. It's just something I put together. But we're living down here right now. All right, so let me try to get both numbers in. We're living around there. We have very, very low interest rates. So this is the 10-year Treasury, very low on that end. And sure enough, this means there aren't a lot of opportunity costs to holding on to largely non-interest earning money. And so we're holding on to a lot of it, which means it's not changing hands as often as it might otherwise. So you have a lot of money in the system, a lot of raw material, the sort of kindling that would otherwise stimulate inflation. But you also have a kind of demand accommodation where we can't get enough of this stuff. So the Fed is introducing all of this money, but we are simultaneously absorbing it or holding on to it, or as we like to say, accommodating that additional supply in ways that keep the price level relatively stable. See, if this goes the other way, that's a world where we're all chasing after each other saying, please take my dollar because I don't want it anymore. And that's when the value of that money is going to fall. But at the moment, the sort of long run relationship between money and inflation, one that I strongly support and believe is true, is not exactly the way we want to think about this right now because velocity is so low. And in my remaining minutes here, let me show you another way to sort of think about this insatiable demand of ours for very liquid forms of money. Here's M2 again. I showed you M2 in terms of growth rates a moment ago. Remember, you had this growth rate picture that, I don't know, looked like this, and then it went like that, right? Well, that's why it went like that. The level of M2 jumped dramatically in recent quarters. And so you've got a lot of this currency plus checking accounts plus savings accounts and so on, all the stuff you could go to lunch to Jimmy John's with and buy lunch. But what's interesting about this is not the spike. You knew that already. It's the composition of that spike. Most of it is suddenly M1. And this is pure currency and checking accounts. So in other words, there's been this very interesting compositional shift in the money supply or the money demand. In equilibrium, they're the same thing, we're not holding lots of M2 only. Within M2, we're holding mostly M1. And again, M1 is really the stuff you can go to Jimmy John's with and buy lunch with, no questions asked. It's pure currency and checking accounts, very, very liquid. And that has taken up the majority of M2. Again, if we were in an environment where we did not want to hold on to money, you would not see a movement, a shift into the most liquid forms of money. You would see something quite different. The majority of the composition of M2 would be blue, not red, right? So this is, again, a demand for liquidity. And then finally, so what's the problem, right? Sounds like everything's okay. Actually, it's not. And the reason it's not isn't because the money supply has increased. I've just demonstrated, I hope convincingly, that demand for money has also increased. So that needn't be inflationary. But the problem is inflation expectations. This is my last chart. But monetary theorists like to say that inflation expectations are either anchored, the metaphor meaning that the expectations are where the central bank would like them to be, low, stable, around 2%. So we all price accordingly, and we don't bring about higher inflation simply by anticipating it. Or it's unanchored, which means we're off on our own, anticipating inflation rates that are, as a practical matter, usually higher than the central bank would like us to sort of price in. Well, right now it appears there's a bit of unanchoring going on. Here's the 2%. And this is where inflation expectations appear to be right now. Now, they've been above 2% before. All you have to do is look left in the picture. But again, this is the concern, that if the central bank loses control of anything, it's not going to literally be the printing press. They can shut that off. It's not the growth in M2 that's the problem. It's the expectations surrounding the growth in M2 that's the problem. Because there is a sort of expected, and it will come, tendency to inflation. If we expect it, we, if you will, price accordingly. And that has the tendency to fulfill the anticipation. So I'll leave you with, the risk here, I think, at the end of the day, from 30,000 feet, is not so much the quantity of money in circulation, it's the credibility around the central bank and its willingness to do what it needs to do when the time comes to combat that inflation. So that's all I have. I welcome questions. Thank you again.
So Joe has opened it up for anyone that has a question. We'll give you a couple seconds to formulate that in your mind. Okay, so we had one question come into the chat. It says, how do you see the functioning of the labor market in terms of driving future inflation? In general, there seems to be a substantial number of job openings, but still substantial unemployment. Could create a bidding war between employers for labor and be an inflation factor?
Yeah, that's a great question, Eric. You must have gone to a very good undergraduate program in economics, and it's so good to see you in Zoom sense. Yeah, that's a really good question. Labor supply, if it's constricted, that will raise wages. And that's not an increase in wages due to an increase in productivity. It's an increase in wages through the bidding war that Eric so eloquently describes. And, that's in effect the same thing as not having the bodies in the labor force. It's a decrease in supply. It places upward pressure on the cost of labor. GDP is about 70% wages. Wages times labor gets you about 70% of GDP. So it is a driver of costs in the economy. We used to think of oil prices. It's labor that really matters in terms of a single driver. So yeah, the labor market needs to heal. And I say needs to heal because based on the labor force and so forth, it appears that the bodies are there, but the circumstances are not ideal right now. And there are myriad explanations for this. Some of it could be childcare, some of it could be health concerns, some of it could be safety net, unemployment insurance, and so forth. It's complicated, but we all, I think, have a sense of who the cast of characters are that might be driving this. But it's a good point. That's a supply constraint that needs to be relieved. in order for the 4.2% inflation to be transitory. So it's only transitory to the extent that we can heal that labor market. So that's a really good point.
Thanks, Eric. Anyone else have anything that they'd like to ask before we move on? If questions come to you and you'd like to type them into the chat or jot them down, we will. I think, Joe, you're here till the end, so we can take wrap-up questions at the end as well. So
absolutely. Thank you.
All right. Thank you very much for joining us today. With that, I'm going to turn it over to Dr. Wang. And if you all recall from a year ago, Gerald had to run to his car and find his neighbor's internet to join us. So we're pretty happy that he didn't have to go through all them hoops today to join the Ag Dialogue session. So with that, I will turn it over to you, Gerald.
Right, thank you, Heather. Hope my internet is stable enough. So today I can go through my presentation. Right. You can see my screen, right?
Yep, looks good, thanks.
All right, so it's a perfect segue from what Dr. Santos talked about. So I'm going to talk a little bit more about market environment or implications of the macro policies and macro environment. I will, again, I'm Gerald Wang from Ness School. So we're going to talk about a hodgepodge of topics instead of a focused idea. First of all, just to give you an overview of the COVID situation and talk about the stock market and the commodity market, where they are, and also how the market participants perceive the fear or the uncertainty in the market. In the end, we're going to talk about the interest rates, inflations, and how that impact market. So we'll eventually drive to some market implications. So that's my plan. Just take a look at the confirmed COVID cases from, this is from the start of the year, and just to show you worldwide the major economy. And you can see US right here. We see the confirmed cases clearly has been flattened, the curve, and globally still increasing, and Europe also flattening a bit. The concern now is India and Japan and also Taiwan. And so there are implications on especially supply chain related to chips, which mostly produced in Taiwan. So that's the general case, right? So it's uneven in terms of the COVID situations. And then here is the vaccinations of the progress worldwide. US, we should be proud of US has achieved vaccination rate. It is 38%. That's the highest among developed economies. So you can see others compared, like India, 3%, UK, relatively high, and Europe is catching up, so on and so forth, right? So that's what we should be optimistic about, but this is very uneven. And you can take a look at this map of the vaccination. The dark green means a high vaccination rate. This is fully vaccinated, means 2 doses for most of the vaccines. US pretty high over here, and elsewhere, Canada is there, but elsewhere is pretty light and pretty, so that's the situation, right? So in other words, we are still living in the COVID world, and even though it's I call it COVID post-COVID, but it's really not post yet. In terms of where the market has been and where it's going, I'm talking about stock market. So the white line is the S&P 500 index, which is usually we use it as a proxy for the overall market. This is from the really pre-COVID in terms of the market highs, February the 19th. And that's the all-time highs of the S&P 500 index. And then we had a 30-some% of a dip. And then recovered, V-shaped recovered, and all the way from that all-time high to now is close to all-time high, is up 23% from the last all-time high. And if you are counting the bottom of the market, is 86%. That's crazily high, and clearly the market is running way ahead of the economy, which Dr. Santos kind of alluded to, the macro environment. And that's the top line. And you can see basically it's pretty much straight up. The bottom one is the VIX, one of my favorite index, is a fear gauge of the overall market. Just give you a sense of how the market participants perceive going forward for next 30 days, for next month. And the VIX level, you can see from highs of 80s, close to 80s last year, and it's trending down. And there are some bouts of, higher VIX, like during the elections last year and the Georgia runoff. And also recently, the inflation fear that Dr. Santos mentioned earlier, right? So, but overall, the fear is kind of dampening, and which is good news, right? And at the end, at this moment, the market is kind of running into resistance and reach all-time high. It's hard to feels hard to get a little higher. And a little bit more about the fear, the VIX itself, and it's contained, as we can see. This is what we call the curve, the yield, the term structure of the volatility, which means like here, currently this is the 1 month volatility. Is actually the VIX futures, volatility futures. It is at 22. And the 2 months is lower than 24, and all the way 5 months and 9 months. So you can see it's upward sloping. It is around the 20-some, lower 20s. And if you remember a year ago, that is actually after the market rebounded. That means the volatility or the fear was already reduced. And that was 30, and that is significantly higher, and it's very flat. At the beginning of the year is really like flat as what? So it's 27, and so 30, 27, and it's 20. Clearly, we can see the fear is kind of by and large getting removed, and so that's the situation, right? So we're not getting back to the crisis mode and anytime soon, and the market is not perceived that way. We're not talking about at the moment, but also how the market perceive next 9-12 months going forward. And so that's the kind of equity market and equity volatility. And then talk a little bit about commodities. The group of ag groups here probably are pretty interesting here, and which a lot of this is what you know already. And let's just put it in context. So I selected a couple of major commodities. And the most obvious one, this is on headline news pretty much every other day, is the lumber. And this is year to date. This is all normalized, and the rate of return based on the futures is 132%, right? Even with the recent corrections. The other group of commodities, the corn, crude oil, and the copper, they are increased by 30% or so in that range. Soybean 17%, and the S&P about 11%. So commodities in general are performing very well relative to the stock market, and some commodities perform way more. And clearly, lumber is related to housing, related to all this disruptions, demand and the supply disruptions. Right, so that's good news for the ag commodity folks and ag commodity producers in particular. And this is probably something that you know very well. The grains, this top one is the corn. This is the term structure is in backwardation. Is kind of normal in backwardation now. It's pre-harvest, but the slope is a little higher than usual, so that is that means the market anticipated the corn futures price will probably be a little bit lower in the future. And also at the bottom is, no, the top is soybeans, sorry. Top is soybeans and the bottom is the corn, right? And so a little bit of backwardations, and there is a little bit of shortage, potential shortage or disruption in the supply side of it. Most likely that's the case. And something that probably a lot of you folks will pay attention to, especially recently, if you notice, actually 2-3 days ago, and there was a big drawdown in the cryptocurrencies, and I showed here Bitcoin and the Ethereum. At the bottom is the Bitcoin, 43 drawdown, and we are talking about just literally a couple of days, less than a week, and Ethereum is about 47% of drawdown. And that is rather significant. But even with that drawdown and the market actually getting back a little bit, is 280% for Ethereum, 41% return year to date for Bitcoin. So this is, we call that alternative investment, and it's some other, I lumped into the commodities as well. And so that is clearly commodity as a whole is performing very well, even with this big drawdowns. And you can see here, and I have little graph regressions that actually shows the Bitcoin regression. Think of Bitcoin as some stocks or some equity investment, and I regressed it against the S&P 500 index. And so I calculated that coefficient is called a beta. It's just like beta from your finance classes. And the beta is actually, if you see here, is 0.9, right? What does that mean is Bitcoin and cryptocurrencies, those major ones, are behaving like the market. And they are actually quite correlated, at least recently, in a recent year, right? So it's as a way of a speculation, but also it's very behaved much like the equity or risk on investment, right? And this is just show you here, and you know very well, Bitcoin, the drawdowns of 40s and 50s and 80s is not like crazy. You can see there are many of those drawdowns actually tend to happen very quickly, right? So this most recent one actually is 51% if we calculate it properly for the highest recent price. So even with that, the commodities, cryptocurrencies return is still very high, right? So that's the price performance, and how about the volatility, relatively speaking. And this is based on the volatility, we call it implied volatility, what market perceive going forward for next 3 months. And so I plotted several ones here, the corn. And I want to highlight the corn one is right at the top, is 40%. And so this is kind of unusual that we need to pay attention to. And the crude oil, and this is around 37%. And then we have soybeans and the S&P 500, and then live cattle. That's what I can get hold of in terms of volatility. And clearly you can see the difference. Corn has the highest volatility, which is unusual. Historically, is even though it's high, volatility is high, but it's not as this high, right? It's higher than crude oil. That is as I said, unusual. And this happens around April, early April, and late April. Okay, so that's something that we need to pay attention to in terms of the corn volatility. That's the market. There is a lot of concern about probably the supply situations, productions. I showed this graph last year, and this is the updated version of it. You can see the corn volatility, the white one. This is again we call term structure the volatility or the fear in the market. And the corn, currently we're talking about September, the relatively more actively traded. September and December, one is pre-harvest, one is post-harvest, and it's 40% versus 36%. That is still very, very high. And this is the current volatility. And if you compare to this red one, and that is the beginning of the year, right? And so that is pretty much tilted up completely the whole curve, and or relative to what we had at the beginning of the year. And then soybeans, that's a little bit lower, and is not as dramatic compared to the beginning of the year, right? So what about last year? Just to give you some comparison, I didn't put everything together, so that is not so crowded. Last year, and the same dialogue, we had 26% is 23%, right? You can see very significant, especially the pre-harvest uncertainty is high. And post-harvest actually happened to be pretty similar. Actually, in this case, 23% is identical, right? So there are something that producers need to be watchful. That's the volatility. And next is so all this kind of tie into what Dr. Santos mentioned earlier, inflation, which has implications on the interest rates, which will dictate a lot of market reactions. And here, this is the interest rate yield curve, right? And you can see very clearly, and this is a yield curve, which is just to refresh. It is the relationship between the interest rate and its maturity or the tenors of different U.S. Treasuries from the short term to long term, like 1 month to 30 year, 1 month T-bill to 30-year Treasury bonds, and the interest rate. This is last year. The bottom one is last year at the same time, and this the middle one is last quarter, and the top one is right now, literally just a couple of hours ago that I take out of Bloomberg terminal. So clearly you can see this rising, and also steepening. The curve is getting steepener, right? And so that's very, very clear, and there is no denying of the rising interest rate and also steepening yield curve. Okay, and we're going to talk about the implications in a moment, but keep that in mind. This is one of the most important pictures. Interest rate is rising, and also the yield curve is also steepening. And even though the interest rate is rising, but the mortgage rates, that's a lot of us consumers will care about the mortgage. This is 30-year mortgage rates, and historical average for the last 5 years is 3.8%, and now we are talking about 3%. And even though it's rising from the bottom, but it's still relatively low, and actually quite low, and in the historical context, right? So that means you can still take advantage of this low borrowing cost as consumers. And this is the inflation expectation, not from the economist's perspective, but rather the trader's perspective. This is the TIPS or inflation protection bond versus the nominal bond, and what is the rate difference, the spread, which tells you what inflation is actually embedded in the trader's mind. You can see 2-year 2.8, and even to go all the way to 30 years 2.3. So it's not like crazy. It's less than 3%, and it's actually going to be almost like what Dr. Santos actually predicted using the graph, and it's actually gradually declining. So it's not like crazily high of a CPI, at least the headline CPI inflation, right? So with that, even though the inflation number is not going to be high based on the traders, from traders' perspective, but I think there is something that is changing, and this is completely my view. It's not like scientific or based on scientific research. And this is something that is important we need to point out too, which is a policy change from the very focused on monetary policy for the last decade or so to more fiscal dominant policies, and which has a lot of implications. And in the past, it is more of controlling interest or controlling monetary supply to try to stimulate or impact the economy. We sometimes call that a trickle-down economy. Now potentially shifted to direct payment, more fiscal dominant policies. And we can see, and obviously we know last year is unusual of the CARES Act, and that is more fiscal policy, 2.2 trillion, COVID relief later the year, and also 3 rounds of stimulus checks and the American Rescue Plan, and that is another $1.9 trillion. And we have the Biden administrations, and also still thinking of Jobs and Families Act, that is about $6 trillion, and that's infrastructure and education, childcare. That's in the plan, and we don't know how that will take shape, but that's a scenery change, and a lot of people call that a regime change. We don't know if that will be permanent, but it looks like, my opinion, that would be more of the direction where the policy, macro policy is going. And so now with this in mind, the federal Fed policy actually has something. This is another graph that you may want to keep in mind. Even though we can see monetary supply is increasing, and also the reserve balance is also increasing. And here you can see the red one or orange one is actually the Fed balance sheet, and is increasing. And if we just scale it by the S&P 500 index market cap, all the market cap added together for the 500 stocks, and you can see for the last almost a year or so, it is pretty much flat. The ratios of the Fed balance versus the S&P 500 market cap, right? Even though it's increasing the balance and basically more money supply, but in the end, you can see clearly the market is really basically following what the Fed is doing. More reserve balance, basically more money supply in some form of shape, and the market will go up, right? And the other one is similar, but slightly different. The other one is the Federal Reserve instead of the reserve balance, but rather the total balance, but painted roughly the same in the picture here. So that's important. As long as we see the Fed is going to be accommodative policies or stimulative policy, and we can see the market is probably going up. That's a takeaway, and that's by and large that stays that way for quite a while. So even though the market, I think it is going up, again, I want to have a disclaimer here, even though, and I'm trying to predict, but of course, this is not investment advice. I want to make sure I cover this point, right? This is completely my subjective view. And even though market is going up, and I also mentioned the market is probably running up to a resistance, as what we observed in the past month or so. But we can see the market might be going through some sort of changes in the leaderships, like which sectors will do better or what factors will work better. And this is something that you probably should have noticed. If you're not, then you're probably not paying enough attention to how the market is doing, right? This is the graph, and the white one is how the market is doing. And then I singled out the 2 factors. One is the momentum. Think about last year, the price goes up, and then you would think the price of any stock or stock market would go up, and then that's called the momentum. And that tend to be represented by the tech firms and those like the fan stock and the growth stocks, right? And the bottom one is value ones, and we're talking about Coca-Cola's and Nike's and those type of companies that have stable cash flows, but it's not very fancy. So, so you can see, and the value is underperforming the momentum for last year, actually for the past decade or so. And I just showed the last year or so to give you a sense what is going on. And you can see here, around the election, around the elections, and the momentum is actually declining, and value is increasing, is performing better, and they are converging. And this has been going on, but of course, it's not like straight line in terms of performance. You can clearly see the convergence of that. If you miss this boat, you probably didn't do very well in this market environment. And this is relatively short term. And if we want to compare back in the days post tech bubble in around 2000, it took 7 years completely. This is complete isolated value versus momentum, and took 7 years to really to catch up, right? So this is probably not the 1 year phenomenon or a couple months of phenomenon. Again, this is prediction. I have some facts. There are some is my own prediction. It doesn't mean that it's going to take another 3, 4, 5 years to catch up for the value, the traditional like Dow Jones, the value names to catch up. But it might be taking a little bit longer to actually pan out. Right. I'm going to summarize. Actually, we talk about all this in the graphs and here, and just to capture what we talk about. Very uneven recoveries based on the COVID situation and vaccinations. And then we are experiencing deglobalization or supply chain disruption. This is probably going to last a little bit longer, not a short-term thing. And the policy shift from the monetary to fiscal. And the inflation is transitory or permanent. That's the big question. Nobody has the answer, and everyone has their opinion, but I don't know the answer. And leaning toward a little bit more than just transitory, even though I believe that this is going to be transitory to some extent. And we talk about market trending. And in terms of outlook, and the implications would be, you probably want to stay invested in general, and against the very stimulated, accommodated policies, both monetary and fiscal policy. And the rising interest rate and the steepening yield curve is good for the value names. We're talking about financials, energies, and industrials, and bad for the growth names and tech firms. And that has been playing out for this year, and probably will last a little bit longer, but doesn't mean that it's going to just straight line always that way. Rising inflation is good for commodities in general, but not good for the bonds and fixed income, and you probably want to change your compositions of stocks versus bond composition. For how long? I don't have an answer. And so, and need to watch and see. And the other one is the corporate finance implications. While the interest is still low, you probably want to take advantage of this low interest environment. And also the financing cost probably is also increasing as a result of increasing interest rate. Given the supply chain issues and inventory issues and deglobalization trend, and you probably want to be a little bit more careful about working capital management in general if you are dealing with the corporate side, right? That's all I have. Thank you very much. And we're just to open up for questions.
Okay, thank you, Gerald. Any questions? Please feel free to type those in or unmute your microphone and ask them. So we do have one came in. It says, do you have an opinion on the classification debate of cryptos as securities?
Right, this is a big question. Thank you, Eric. That's a good question. And secure, and I think the debate has not been completely settled. As for Bitcoin, which is unlike others, which has been largely determined to be more like commodities or properties or commodities, not as securities. And that has been by and large settled a couple of years ago, maybe a year ago, but others not. And it has a lot of implications if it's classified as a securities, and the regulations can be very different, and the issuing, especially security issuance versus the coin issuance are going to be very different. And and where it will go, I have no idea, and we can see the current chair of a SEC chair is going to be probably more open-minded in terms of regulations on the cryptocurrencies in general. And for those who are interested in watch his lectures, MIT lectures, is very, very good. I actually watch all those and suggested to watch that too. If you are interested in cryptocurrencies and blockchain technology, he offered a class at MIT just before a year ago or so.
Okay, thank you very much. Any other questions? It's always a pleasure to work with professors who are used to working in a certain time frame, that their class runs from this time to this time, or the students get up and leave. They were right on schedule with their 30 minutes apiece. So extension people kind of tend to drift into, oh, we'll just take a little extra minutes here on the end. So any other?
Yeah, so I'll do that. I'll bring that extension back and keep it. Just not so much question, just comments on stuff from farm country and things I've heard from dealers. So one of the things was a purchase of a four-wheeler or ATV. The dealer normally gets 20 to 30 in a year. Last year he got 4, and that's all he could get. They had closed the plant, and I think it was more labor and then some parts issues. And more recent has been on metals and secondary type equipment lines. He could get, there was two increases, one of 10% and another of 17% that they were going to pass on to him. And then also he couldn't get quotes, or they were good for 48 hours, and they anticipated that going down to just a day, that they would quote him the price. If he didn't take it, he would be subject to wherever it went. And I don't know whether that could be up or down too at the time. So I just thought it interesting in that supply chain. There's some, and you guys have stated it, probably really big issues that got to get worked through yet. The other one that would fall in, and I started to hear, is some of the chemicals, more on the herbicide type and pesticide, some shortages there. So just comments versus any real question out of that.
Yes, that's a great point. Actually, this is your first-hand experience. That is real, and of course, nobody knows how long it will last. When we reopen completely, get back to normal. Yeah. But it will take time to sort through this thing, and it's challenging as well.
Thank you, guys.
Thank you.
Okay, I don't see any last minute questions coming into the chat or anything like that. However, if you come up with something in the next day or so and you want to ask these individuals, I'm sure they would get back to you. So if you shoot me an email, I will forward on your questions to the appropriate individual, or both of them if you'd like to hear both of their sides of the story. So with that, we're going to invite you to the June session. If I check my calendar just quick, yep, June 8th at 10 o'clock. We will do this again. That registration is live on the SDSU Extension events page at this time. So if you are interested in joining us next month and you want to just make sure you get registered, please go do that right away. Otherwise, thank you to our presenters. Thanks, Jack and Matt, for being on and joining today. And thank you to all that attended. And we will get this sent out to everybody directly. So thank you very much. And we will talk to you later.